Hey gang, it's Dave Littlejohn, and I'm here with an update. It's the end of May, the 31st. The markets are closed, and it's been a challenging month of May. We've seen a fairly significant decline for the month, and looks like some headwinds that are starting to come into play here. So what I wanted to do was give a brief discussion for those of you that are interested in what our take is on the markets. I did just want to show you here. This is a free resource that you're welcome to look at. It's called finviz.com. Financial visualizations, kind of cool. And so not an endorsement for the site per se, but it's one that we like to use on occasion. And you can see the Dow was down almost 1.5% today. The NASDAQ similarly almost 1.5%, and the S&P 1.3, also almost 1.5%. This is the part that's really telling to me. Notice this sort of speckly chart here. I'm going to click on it. And what you can see now is this is a look at the S&P 500 and over here, one-day performance. Here's the interesting thing. If you look, notice all the different squares. So we have Google in the technology sector, Amazon over here in services, Apple down here in consumer goods and electronics. Notice how large those squares are compared to all the others. This is something that we'd like to talk about. It's called capitalization weighting, or a cap weighting. And what it says is the larger the company is, the bigger the percentage of the index it represents. So as you can imagine here, if 5 or 6 of the largest stocks have a really good day or a really bad day, they can have a very significant influence over the performance of the entire map, so the entire S&P 500. Now we're just looking at this today. What I want to show you, what does this look like for the year now? Interestingly enough, or let's say year to date. So we'll come on down here to year to date performance and click there. And you'll see a lot more green. For the year, the markets have done pretty well. Some of this is because of timing, of course. In the fourth quarter last year, there was a significant decline, and then a rebound that was fairly significant at the beginning of the year, and then it's been sort of flat for the last few months. Let's take a look not at year-to-date numbers, but we'll come over here and look at one-year numbers. Notice now the gains are not nearly as large. You can see for the year, companies like Apple are actually negative. Amazon is about a 12% year-over-year return, but it's not nearly as high as it is just year to date, and that's because it's now taking into account the volatility that we had at the end of last year. I find what's interesting is that the markets are, there's a lot of winners and losers. I want to show you a few different ways that we're looking at this, and then I'm going to give you some thoughts about where things may be headed. This is a look at the S&P 500. It's kind of a fancy look at it because there's a lot of lines going on this chart. But I can make it a lot easier for you, and I will in a second. Here's the interesting thing, though. You can see this goes back to April, and there's these little lines that are sort of green and red buried underneath. And that's been the trend of the market, up and down. I've drawn a white line here in between, and this sort of shows you how everything's smoothed out. It went up and it went back down for the month of May. The rest of these lines are some things that I use to give me an indication of where I expect the market to be. So this was a prediction for the week that was placed on Monday, and you could see I expected the markets to stay in this range, and they've fallen below it. That's typically a bad sign when you have what we would call a breakout. So if we look at this over a grander amount of time, you'll get a different reflection here. Now you can see here was last October. The decline all the way down into December, and then the recovery back up to where we peaked it going into the end of April, and then we sort of came down through the last month. What is this telling me? Well, there's a few things that we want to look at. This is a different way to look at that similar time frame. Again, you see the highs of October, and then everything moved down through December, back up to April, and then back over to here. There are lots of ways that people will look at the stock market, and I think the most important is to keep in mind the underlying reasons that people buy investments, and it's the idea of future profits, and so we're anticipating greater value in the future. But we should still look at some of these elements to get a sense of how people have formally priced them. So what I'm showing you is something that we call technical analysis. It's a little nerdy, but let me spare you the boredom and get through this real quickly. We have some moving price averages, and I've kind of outlined them here. Here's key areas that the market is looking at. The low point that we saw last December, And then this is a smoothing indicator. So this is sort of an average of those prices over time. And it bottomed down here at about 2,407. And do keep in mind, this is the S&P 500, if I didn't point that out. We also saw one of our moving averages bottom out here at 2609. We saw a bottoming out also of the 100-day moving average here at 2679. And then the 200-day and the 50-day crossed at 2758. And there's a few other key numbers in there. The ones that we're really watching, I drew these green bars on. So 2679, up here right at 2776, and then just below it here at 2758, which we more or less hit today. We finished a little low at 2752. Then you've got a 10% correction area at 2661, and then bear market territory down here at 2365. That is a pretty realistic number to keep in the back of our minds. And here's why I wanted to have the conversation with everybody. In essence, what it comes down to is the trade war issue. And I don't want to talk about the politics of it. I just want to talk about the mechanics of it. If we expect the trade war to become a long-term experience, right? And so we're talking about something that could last for years instead of weeks, then that's going to change the behavior of the marketplace, and it's going to change future profitability. What we're introducing right now is the unknown variable, okay? And what's making it really tricky is the unknown variable includes some political elements that really are unpredictable. The most recent was the announcement late yesterday that the market had to digest today that the Trump administration and Donald Trump specifically are now looking at implementing tariffs on Mexico in response to immigration policy. Now, again, I'm not making a commentary on whether this is good, bad, or otherwise, but what I'm telling you is when that becomes an instrument that's being used for political reasons and not just economic reasons, well, and the fact that it was sort of a surprise announcement, it's very, very hard to predict these things. So it's hard to price something like this into your stock model or your expectations. Do I think it changes the long-term viability of the stock market? Not really. I think that capitalism is pretty clever and that eventually it will figure out how to retool and be profitable in whatever new environment is created. But do I think it could dislocate things in the short term and that we could see some volatility and some swings up and down in your investment account values? Yes, I definitely do. What level of prediction? Well, it's right now all we can make is educated guesses. When you have a political regime that will do things that are very unexpected and without any guidance, it's very, very difficult to anticipate something like that. So we can't guess at every variable. And every now and then the market's going to get a curveball thrown at it like this, and it's just going to respond. So I think that's what we're seeing right now. But let me just give you a little further insight into how the market is responding and how significant this is. What I have here is a chart of 9 different exchange-traded funds. Now, these are the exchange-traded funds that closely mimic the underlying components of the S&P 500 index. So you can see up here we've got consumer discretionary, we have consumer staples, we have an energy sector, and so forth. Why the exchange-traded fund? Well, it's a pretty good proxy, or it's a pretty good approximation of how those individual sectors are moving within the greater market, if you will, or within the S&P. So here you see the trend, and again, the fuzzy red and green lines here are the daily up and down trends, and we're looking at 2019 and all the way back about a year to 2018 at about a 1-year term here. So notice this is July, so this would have been about June of last year, and here we are coming into June of this year. So you can see the trend was down through the end of last year and then back up, and then this pullover and a decline. Well, what I'm looking for in this chart is give me a sense of whether or not prices are trending higher or not. And in all cases, we see that have this sort of V pricing in each of these. And what's unclear, the smallest V is actually in the utility sector here. Energy is actually a V that's gone lower, right? You can see it's actually in sort of a slump, and utilities are kind of higher. That the utilities in particular make sense if you follow the way the markets operate, what it's telling us is that's a flight to safety. But you can see that there's a lot of sideways movement in the market, and there's been some big swings up and down in the last year. So it's not been a great year for stock investors. Interestingly enough, bond investors, you'd think with interest rates super low, they couldn't go any lower, and yet there has been a little bit of a rally in the bond market, so go figure. Now, this is a look at sectors of the market, but what about different sizes of companies? Well, that's that market capitalization that we showed earlier in this video. Here's a look at the market capitalization right now, and again, we're talking about these are large stocks here, medium-sized stocks, and small stocks, and then we're trying to reflect using an index proxy to approximate the value. So you'll notice one other thing that I didn't point out on the last chart. Notice a couple of these have red backgrounds, right? A lot of them don't, but that's a signal that I use internally that just tells me when the slope, and I'll show you what we do. I'll just go in here to chart properties, and I'm just going to add this right here. And why did I do that? Well, the slope of this yellow line is negative. So when I see a negative slope, then what I want to do is go in and notify myself, if you will, that these are showing signs that something is unhealthy. And so I'm changing the background to reflect that. And even here, when it's all said and done, you'll notice that almost everything has a red background. Now, this is not U.S. stocks. This is actually European stocks, emerging markets, and this is the gold market. Because a lot of people ask me, is gold a good investment right now with stocks being shaky? And what you can see, again, is the trends are not really well established heading upward, at least. So very much a sideways market with a lot of up and down movement. All that I can tell you is it's very reflective of the uncertainty in the marketplace, and I don't see that changing anytime soon. Given the current political environment, it's really tough to make a prediction as to where things are headed. But I do think that we need to be aware as investors that the economy hasn't imploded yet. And so when folks are saying, well, it's now a good time to sell, I don't know, right? I mean, you're timing the market and it's very difficult. Here's my take on this for most investors. And keep in mind, this is a video. Your advice for you is specific to you. So I don't want you to consider this as general advice, but I do think that this is important to keep in the back of our minds just as a concept. And that is, it's really tough to be an investor when you don't have your money invested. So if you're trying to time the market, you're doing a lot more trading than you are investing. I'm not going to say that there's not an appropriate time to take risk off the table and change your investment strategy to be more defensive. But if we get defensive too early and then the markets resolve themselves and move higher, you end up kicking yourself for it. So unless you have a really compelling reason not to be an investor, I tend to err on the side of being an investor. And I can't come up with a really compelling reason not to be yet, other than taking a guess and hoping that it ends up, and I hate doing that. I hate guessing, hoping that the markets will fail as a way to bail out my guess. I don't want to be there. So the data hasn't told us that we need to react just yet, but I did want to give you all a sense of what is going on out there. So that's the story for this week. Looking forward, I've done a number of outlooks. I'm not going to cover that in this video. It's gives investors, I think, the wrong idea, because one, people start to believe that either I can predict the future or that there should be some kind of actionable data just because I can show you the underlying behaviors of the market somewhat. I don't think that's it. I think that if you're uncomfortable with what's going on in the market, you should really examine what kind of risk tolerance you have and whether or not your investment strategy is aligned with your risk perspective. Otherwise, I think it's just good to know what's going on out there and sort of proceed as you need to. And what I'll make this offer, many of the people that see this, we send these videos out to our clients. Okay, but if you are not a client, you'd like a second opinion, something like that, give us a call. Okay, you can reach our office at 541-375-0898, and you can also email us at info@littlejohnfs.com. and we're on the various social media environments and so forth. So we'd be delighted to help you. We've got a number of different tools that we can do some analysis for you and show you maybe where some soft spots in your investment strategy are, and give you some ideas about what you could maybe do to shore things up or realign with your risk perspective. Again, that's going to be unique to you. So none of us is identical, but you get the idea. So that's it. Wanted to give that brief update and tell you that what we're keeping an eye on is this concept of structural change. If we have permanent tariffs, it's going to change the way the markets behave, and the markets will start to price that in. And right now, we haven't seen it formally, but we've seen pretty good indication that that could be coming, and the markets are having trouble sorting it out. So this behavior is not unexpected, but I know none of us likes it. It's much better if your investments just go up and up and up all the time, but that's not always how it works. So. Anyway, sorry the video is so long today, but hopefully you could carve out some value in this one. And of course, we did a little summary in our email that we sent out as well. Until next time, the weather's getting nice, so I hope you're enjoying your summer that's just around the corner. Take care, everybody. All the best. This is David Littlejohn signing off.